Hello and welcome into Lowcountry Money Talk. We have a lot to talk about. Phil Bloyd is joining us, of course, with Revolutionary Financial Group. Phil, nice to see you.
Good to see you again, Jessa.
Nice suit. I always compliment your clothes.
Thank you.
I love your outfits.
All right.
Okay, now that we got that out of the way, the important stuff.
That was important.
You know what? We lost all our money.
Well, you know, maybe we can find it again.
I hope your clients are doing better than the average. I'm sure that they are. We're going to talk about that because the average isn't looking too good. We're going to talk about some current events. So groceries still high, gas prices still high. We're experiencing lots of shortages. You know, these are the things affecting families. A lot of current events, issues that are really hitting home quite literally.
Yeah.
So what?
Well, you know, that all affects just the psyche too.
Yeah.
So it's like when I'm listening to some TV shows or something, you know, they're like, oh, the economy's great and this and that. And I'm like, what planet are they living on, you know? Yeah. So we just need to know where we're at. I don't think burying our head in the sand is going to be a good strategy. So measuring how we are and compared to the market. So let's say the S&P index is down year to date, maybe 20% or so. The NASDAQ's down 30% or so. So let's say 25%. So if I do a comparison on my holdings and I am under 25%, then if I wanted that much risk in the market, then I should feel, I don't want to say good because no one likes to be down, but I'm beating market average. Right.
So let me slow that down just a little bit. So you're basically taking the S&P down, which is, like I said, 20-ish, NASDAQ's down, which is 30-ish, and you're taking those as an average of 25% down total. So when you're looking at your own portfolio, if you're only, let's say, 20% down, you're actually beating the market.
Beating the market. Now, you still may have heartburn over that. You know, it depends on your time horizon, how much money you're taking out, all these different things. But you know, if you're going to be invested in the market, you have to have a measurement, and the measurement are going to be the market indices. And if you are beating the market indices, but you're still feeling, you know, heartburn or anxiety, maybe you have too much exposure to the market. So then that's a whole different thing.
Well, and that goes back to what you're talking about mindset-wise. So if you're beating the market, but and you're 20% down, technically you're beating the market, and that's good, but if that's not where you feel good, where you want to be, then you're overexposed. Yeah. Now if you're not beating the market, that's a whole nother category, and there's certainly people in that category.
So the market average is 25 between the two indices, you're down 30, you're down 35, then we've really got some issues. We've got to figure why, what's pulling you down. I think in this particular market, up and down, and you know, my feeling is that we're probably not down all the way, of course, yet. So you know, we've got some ways to go. So if you have too much exposure, you know, we don't really like selling low or whatever. So you may kind of average yourself out of the market, you know, on up days, uptick days. Yeah. So maybe you have one position, you have several shares, and you're like, well, I'm going to liquidate 25% of those shares today because the market's up, and I'm going to move them to cash, and I'm going to live to fight another day or something like that.
Okay. Ooh, this is a lot to sort of digest in a way. It's interesting though. This is a really important topic because we are used to. We just came off of experiencing, you know, so much success in the market, and whether or not you were beating the market or you were behind, you're probably still feeling okay about your portfolio.
Yeah, sure.
Now here we're dealing with the the entire reverse situation where we're really having to figure out if where we're headed is the right direction, and you know, certainly people who are in or nearing retirement, this is a little bit of a scary picture. Sure. So we have to make sure we unpack this well and head them in the right direction. We're going to head to break in a minute, but there's lots more to talk about. Obviously, you know, the quarter is about to end here, so we're going to be able to talk a little bit about, you know, what we can expect from the corporate earnings that are going to be coming out. We'll know whether or not we are truly in a recession here pretty soon. And we'll discuss a little bit more about that when we come back from the break. We'll be right back. All
All right, we are on the other side of this break, and this is Lowcountry Money Talk, where we're talking, well, everything that has to do with finances and what's going on in the current economy. It's a little bit of a tough picture, but that's okay. We're going to tell you how you can change that for yourself and make it a little bit better of a picture. We've got Phil Bloyd, who's joining us with Revolutionary Financial Group. We need you, Phil. You're the expert here.
Yes.
Thank you for being here.
I can't take the summer off.
You can, no, unfortunately not.
It always happens at the worst time.
We really do need the piece of the puzzle here that's most important for our viewers, which is things aren't looking great.
Right.
Obviously, prices are high. Inflation is really getting us. Pretty much you're looking at S&P down 20%, NASDAQ down 30%. However, there are things that we can do about this, and we want to make sure that we focus on that.
Right.
I do want to back up a little bit. We are going to talk a little bit about what the end of the quarter looks like, corporate earnings, and what that tells us, whether or not we are entering a true recession. But let's talk about what's going on right now. So we're talking about, everything is down. Where are you in relationship to that? Are you performing better than the market or worse than the market?
Right.
But let's back it up to not very long ago when we were experiencing ups. We were feeling good. We were in a bull market 12, 13 years that lasted.
Sure. So if we take out the COVID a little bit, that's one of the longest running bull markets in the last 100 years. So during that time on the shows, if we look back, I was talking about, hey, how are you doing? How's your money? This is money talk. So we'll say, how's your money? So during that time, I could go up to anyone in particular and say, hey, how are your investments doing? How's your money performing? And they're like, great. And I'm like, in comparison to what? See, that's where we had the problem.
Right.
So we have this huge bull run, this bull market. And let's say at that time, maybe the S&P in a year may have been 27%. And your investments were performing 20.
Right.
And you thought, hey, they're doing great and this and that.
I'm up.
Yeah, but we're not measuring them.
Yeah.
So now when things change, that really stands out like a sore thumb. So of course we can't go back in history, but it's really important that you measure those investments in good and bad times and know where you are instead of just saying, oh, well, I'm doing great, Because if I ask the same people these days, how's your money doing? They'll be like, are you kidding? But then again, in comparison to what?
Right.
So they're like, oh, I'm down 15 or 20%. I'm like, well, just remember, if we take 25 as an average, you're still doing better.
This is fascinating. I love the way that you explain this because it's true. If I'm up, I feel good. If I'm down, I feel bad, right? But that is not the way to look at your money. It is all about that benchmark. Where are you in relationship to the market?
Right.
So to your point, if we were up 20 and feeling good, but the S&P's up 27%, that's the time to really take a look and make that pivot. Now, it's okay if you didn't, right? Because you can still do it now. So if you're down more than the market, or even if you're down less than the market, but it's uncomfortable, we can do something about
time horizon. So again, now's the time. Don't just say, well, I'm going to wait. It'll change eventually, this and that. We'll go over some statistics later about, how long the typical bear market runs and all these things. But why wait? No one's saying, hey, I need to sell out and go to cash. But obviously, if you're not performing down or up to the market standards, there needs to be some analysis done.
Right.
So that's where they need to call in to Rachel, get on the schedule, let's take a look, let's see where you are, let's do a comparison, but also let's look at time horizon, income, how much you need to take out, and all these other things.
Yeah, so if you're watching right now and maybe you're down more than the market, or you're down at all and you're uncomfortable about it, it's time to, or maybe you don't know. There's that too. That's when you want to give Rachel a call, do the full portfolio analysis, risk assessment, just see where you are so so you can pivot. And that's really what this is all about. We didn't get to corporate earnings or what really the recessionary picture looks like, but we still have half a show left.
We'll get to that next.
I'm glad we got to what we got to, though. That was important. We've got more important topics after this break. Stick with us. Okay, this is the second half. Can you believe it? We're halfway through the show already.
Goes fast.
It does. It's light speed. This is Lowcountry Money Talk, and it goes fast because we've got a lot of important things to talk about. Namely, current events, how it's affecting you, and portfolio, you know, just really knowing where you are with your portfolio and where you want to be. So we've spent a good amount of time on that. It's really, really important stuff. Phil, I want to spend the next little bit of time talking about what the end of the quarter means. Okay, so I want to unpack really what is a recession, are we entering one, and talk about corporate earnings too. I'll let you, navigate us on those.
I'll take charge of it. Okay, so here's where we're at. Finished up with June, so that's the second quarter. The first quarter we ended up with a negative GDP. It was like a negative 1.4. So if this quarter comes off anything under zero, we're in the technical version of a recession.
Okay.
Now we may feel it already because we're paying so much for gas, we're paying so much for food, so we can finish up with a technical definition, but if for some reason that number finishes up zero or above, then we go to the next two quarters. So then you skip. You got to have two negatives in a back-to-back. Okay. So still we're inflationary. We're what, 8.4 or something in that range. So that's not a really good number.
No. We're feeling it even worse in certain big categories.
Gas, food,
the important things. Yeah, right.
Look
gas
at the
and food.
price of eggs. Those things are through the roof. So good for your cholesterol. Cut them. Just stop eating eggs. It's like, what are we going to be left with? Grass or something? I don't know.
You made me throw my pen and got me laughing.
We got peanut butter salmonella. We can't have eggs. One by one. I can't drink my baby formula anymore. What are we going to do?
There's a lot of issues. Yes.
We've got all that stuff going on. But what's really going to set the track for the next up or downturn in the markets will be corporate earnings.
Yeah. Okay. So I want to know really what that means. I mean, if I'm invested in the market and knowing that these corporate earnings are coming out, why is that important? How does that mean anything for my portfolio?
Well, Jessa, when we go back to the stock market, we buy a stock, we expect the company to be profitable, maybe pay dividends to us. So when they put out a report and say, oh, well, profits were really down this quarter, or they give us a projection going forward that the fuel prices and this and that is going to eat into our profits, or they give us a negative report of consumer spending or anything, then that can affect that stock and it can move down to another level, because really, we buy stocks because we want the companies to be profitable, and then we can share in that profits with the rise in the stock price and maybe some dividends too. So they're going to start reporting their second quarter. And many people are believing that quarter is not going to be a great quarter for a lot of corporations.
Okay.
So that can send that market down even more. So it's really important that we don't bury our heads in the sand, the ostrich approach.
Yeah, that's
to
tempting
finance.
though.
we need to say, if we're overexposed, if we don't feel comfortable, if we have too much at risk, we need to adjust that. And now will be the time, because these corporate earnings will be coming out over the whole month of July.
Yeah.
And we need to make some changes if we're not feeling comfortable, because those negative reports and those negative forecasts can drive that stock down, and that's going to push your portfolio down as well.
Right. Okay. So and that's a problem no matter really where. Well, it matters where you are against the market, but if the entire market's going down, it's likely your portfolio is going down as well.
Pretty much.
That's a good bet to if you had to make a bet, that might be a good one to make. Okay, well, we have one segment left of today's episode. Where do you want to go from here after the break?
Well, I think what we'll do is talk more about what are some of the alternatives to just being in risk assets. So we'll start with that.
Okay, I like it. Well, we're going to start with that after this break, so stick with us. We'll be right back. All right, this is the final segment, and it's an important one, so we're glad you tuned in here on Lowcountry Money Talk, where we've been really unpacking what's going on in the economy and how that affects your portfolio. We're going to talk to Phil here as we sort of wrap up the show on some other options and what to do with the rest of our money. Phil, we've really focused a lot on the market, and we're glad you've been able to help us with that. Let's talk a little bit though about, we're seeing our investments taking a hit. We want to know if there are some safer options, and are we overexposed for our age?
Okay. If you can't sleep at night, maybe so.
Maybe, well.
But, we always, Jessa, our followers here, the people who watch this so regularly, they always hear us talk about the rule of 100. You take your age, you subtract from 100. Really, that's all I like to see, the exposure to equities.
Right.
So if I'm, as a rule, and I work mainly with retirees.
Right.
So, that's kind of where I'm focused. If you're younger and you're still working and you're contributing to 401k and you have your dollar cost averaging, you just keep on keeping on. But if you're retired or soon to be retired, you've kind of accumulated all your wealth here over the years of the dollar cost averaging, and you're going to take a big 30% hit or something like that. It's going to sting.
It stings.
At retirement.
Right,
so the one thing, we can't control what the market's doing, but we can control how much exposure we have to the market.
So explain, briefly the rule of 100.
Yeah.
And obviously the goal being that if you're older, you want to be more protected.
Right.
And then walk us through some maybe options we should be taking a look at or working with you or our financial advisor on.
All right. So for the last 12 or 13 years, people scoff at the rule of 100. They're like, oh, the market's great. Why would I just want to have that much into it? It's almost like, Noah out there preaching about the rain and you need to get in the ark, for 40 years or whatever. So the thing being is the rule of 100 limits your exposure to equities. So, and you be stocks, mutual funds, whatever your equity portion is, things that can lose value. So if you follow that, you're probably feeling pretty good right about now, because, if you think about it, let's say I have $1 million and only 300 is exposed to the market. So of that 300, if I was down 20%, that's 60 grand on $1 million. Still don't like it, but it's only 6% of the overall holdings.
Yes.
And then I can take income from the other portion while the equity portion is healing, because we don't want to sell low. Right? We want to buy low, and the good news is that opportunity is closer today than it was yesterday.
That's a very good point that you
Now,
make.
it still may be a long way off, but it is closer today than it was yesterday, and the day will come.
Right.
So when I'm telling people, hey, go ahead and get things ready now, I'm preparing you for what's ahead. The market is a leading indicator. It's in the rear view mirror what's going on. The market's already ahead of that. So if we can position now for what we're one day closer for, even though we may have still turbulent times ahead of us, boy, when we hit the gas pedal, we're ready to go. If we're not, if we have our head in the sand and we're ignoring stuff and this and that, we're just kind of doing the same old. We're not going to be ready for the next uptick.
Right.
So the great thing that I like to tell people, to keep it on a positive note, is that once we get done with the bear, we have this nice bull ahead of us where we can get in there and take. Here's the sad part. Many people get gun shy.
Yeah, because of getting stuck
and
in
they
this
never
market.
go back in. And it's like, no.
Yeah.
The rule of 100 says 30, in my example, 30% in equities.
Right.
And you're like, well, I want 0 in equities because the market just got blown out. I'm like, well, that's not going to work either, because you're living longer. You got to have the growth that the market will bring. You got to get into some of that.
Right. That's what I like about how you operate, Phil, is you really have these strategies that keep the emotion out of it and help us to navigate ups, downs, and where we are in life, and to your point, whether or not we can sleep at night.
Yeah.
So it's good stuff. Phil Bloyd, of course, with Revolutionary Financial Group. If you do think you might want to just have someone take a deep dive, look at that portfolio, see where you are risk-wise. Of course, you can call the office and get in touch with Rachel. A good client for Phil is $500,000 or more in equity. So
Yes.
thanks so much for walking us through all this, Phil. And thank
Enjoyed
you
it.
for watching. We'll see you next time on Lowcountry Money Talk.